Preparing for a senior fund accounting, valuation, and regulatory compliance strategies interview. You reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How do you approach fair value measurement for hard-to-value fund investments? Fair value is the exit price a market participant would pay or receive at the measurement date. For hard-to-value positions, I first classify the investment within the fair value hierarchy, then assess the best valuation technique, such as market comparables, income approach, broker quotes, or third-party pricing. I challenge key inputs, document assumptions, review stale prices, and escalate exceptions to the valuation committee. The goal is a supportable NAV, not just a mechanically calculated price. While answering, focus on ASC 820 or International Financial Reporting Standards 13 hierarchy. Observable versus unobservable inputs, valuation techniques, independent pricing, documentation, governance review, and how conclusions flow into NAV reporting. Question 2. What controls would you expect around the monthly or quarterly valuation process? Strong valuation control starts with independence. Front office may provide context, but fund accounting should validate prices using approved sources, tolerance thresholds, and exception reporting. I would expect controls over price uploads, stale or missing prices, level 3 model inputs, manual overrides, and reviewer sign-offs. Any material exception should be documented with rationale and approval. Those controls protect NAV accuracy, reduce audit friction, and support regulatory expectations around valuation governance. Make sure to cover price source validation, segregation of duties, tolerance checks, stale price reports, valuation committee approvals, audit trails, exception resolution, and evidence retained for auditors and regulators. Question 3. How would you value a level 3 private equity investment when there is no recent transaction price? If there is no recent transaction, I would avoid relying on a single input. I'd typically use market comparables, and where forecasts are reliable, a DCF. I would calibrate to the original entry valuation, review company performance against budget, update comparable multiples, and consider discounts for size, illiquidity, or control. I'd also run sensitivities on EBITDA, revenue multiples, and discount rates. The final value must be defensible and consistently applied. In your answer, talk about valuation methodology selection, comparable company multiples, discounted cash flow, calibration to prior transactions, marketability discounts, management forecasts, sensitivity analysis, and documentation standards. Question 4. Walk me through how valuation errors affect NAV, investor allocations, and financial statements. A valuation error flows directly into unrealized gain or loss, which changes total net assets and NAV per share. If the fund has subscriptions, redemptions, or fee crystallizations, the impact can extend to investor allocations, management fees, incentive fees, and equalization. In the financial statements, it affects valuation, income recognition, and partner capital. If discovered, I quantify the error, assess materiality, notify stakeholders, correct the NAV, and document the remediation. Be sure to mention NAV per share or unit, capital account impacts, management and performance fees, investor subscriptions or redemptions, financial statement assertions, materiality, and remediation steps. Question 5. How do you distinguish between Level 1, Level 2, and Level 3 investments under the fair value hierarchy? The hierarchy is about input quality, not investment complexity. Level 1 uses quoted prices in active markets, like listed equities. Level 2 uses observable inputs other than direct quoted prices, such as matrix-priced bonds or quoted prices for similar instruments. Level 3 relies on significant unobservable inputs, like private debt, private equity, or bespoke derivatives. The classification matters because Level 3 requires stronger governance, sensitivity analysis, roll-forward disclosures, and more auditor scrutiny. While answering, focus on input observability, quoted market prices, broker quotes, models using significant unobservable inputs, examples of each level, and why classification matters for disclosures. Question 6. What would you do if the investment manager disagrees with an independent pricing vendor? I would not simply accept either price without support. I'd compare the vendor price to the approved pricing hierarchy, recent trades, broker quotes, market movements, and any security-specific news. If the manager has a different view, I'd ask for objective evidence, not just opinion. For material differences, I'd document the challenge, assess NAV impact, and escalate to the valuation committee. The final price should reflect governance, evidence, and consistency with policy. Make sure to cover escalation protocols, evidence-based price challenge process, approved pricing hierarchy, independence, materiality thresholds, valuation committee involvement, and avoiding undue front office influence. Question 7. How do you account for and disclose valuation uncertainty in fund financial statements? Valuation uncertainty is addressed through transparent disclosure, not by avoiding fair value. For Level 3 assets, I would ensure the financial statements describe the valuation techniques, significant unobservable inputs, changes in methodology, and sensitivity to key assumptions. The Level 3 roll forward should reconcile purchases, sales, realized gains, unrealized gains, and transfers. If uncertainty is material, disclosures should help investors understand the range of possible outcomes and the judgment behind NAV. In your answer, talk about fair value disclosures, significant assumptions, sensitivity analysis, Level 3 roll forwards, accounting policy notes, concentration risks, estimation uncertainty, and auditor review expectations. Question 8. How do regulatory requirements influence a fund's valuation policy? Regulation pushes valuation from a back-office calculation into a governance framework. A fund needs written policies, approved methodologies, escalation procedures, independent review, and evidence of consistent application. Regulators focus heavily on conflicts, especially when manager compensation depends on NAV or performance. I would expect periodic testing of pricing controls, documented committee minutes, and clear record retention. Ultimately, regulatory compliance ensures valuations are fair, consistent, and not biased toward the manager. Be sure to mention SEC or local regulator expectations, valuation governance, written policies, board or committee oversight, conflicts of interest, periodic testing, record keeping, and investor protection objectives. Question 9. What compliance checks do you perform before finalizing a fund NAV? Before finalizing NAV, I look beyond pricing. I would check investment restrictions, leverage limits, expense caps, management and incentive fee calculations, side letter terms, and any class-specific allocation rules. I'd also confirm all trades, cash, corporate actions, and accruals are reconciled. If there are compliance exceptions, I'd quantify the NAV impact and ensure proper escalation. A clean NAV means accounting accuracy and compliance with the governing documents. While answering, focus on investment restrictions, fee calculations, expense caps, side letters, leverage limits, liquidity terms, investor eligibility, AML considerations, and reconciliation of compliance exceptions. Question 10. How would you handle a late trade, late price, or post-NAV adjustment? I'd first determine whether the item existed before the NAV cutoff, and whether the fund's policy allows inclusion. Then I'd quantify the impact on NAV, investor dealing, fees, and allocations. If immaterial, it may be booked in the next period with documentation. If material, I'd escalate for approval and consider a NAV adjustment or restatement. The key is consistency with policy, timely communication, and a clear audit trail for the decision. Make sure to cover NAV cutoff policy, materiality assessment, investor dealing impact, approval workflow, communication with administrators and auditors, restatement considerations, and documentation of the final decision. Question 11. Explain how performance fees or carried interest can create valuation compliance risk. Performance fees create risk because compensation may increase when valuations increase. In hedge funds, incentive fees often depend on NAV, high water marks, and crystallization dates. In private funds, carry may be driven by realized and sometimes unrealized performance, subject to waterfalls and clawbacks. That makes independent valuation review critical. I'd ensure fee calculations use approved NAVs, apply governing document terms exactly, and receive secondary review before investor reporting. In your answer, talk about incentive alignment, NAV dependency, unrealized gains, high water marks, hurdles, crystallization timing, clawbacks, conflict management, and independent valuation review. Question 12. How do you ensure a fund remains compliant with its offering memorandum or limited partnership agreement? I treat the fund documents as the operating rulebook. Key terms should be translated into a compliance checklist covering investment limits, borrowing restrictions, fee terms, expense allocations, redemption rules, reporting deadlines, and investor-specific side letters. During each close, I compare accounting outputs against those requirements. If a term is unclear, I escalate to legal or compliance rather than interpret loosely. That discipline prevents small operational errors from becoming regulatory or investor issues. Be sure to mention translating legal terms into operational controls, investment restrictions, allocation methodologies, fee terms, liquidity provisions, reporting deadlines, side letters, and periodic compliance certification. Question 13. What is your process for reviewing fund expenses for regulatory and investor reporting purposes? Expense review starts with whether the fund is permitted to bear the cost. I check the governing documents, expense policy, invoices, approvals, and allocation basis across funds or share classes. Related party or manager charged expenses need extra scrutiny because regulators focus on conflicts. I also monitor expense caps and accrual completeness. Proper expense review protects NAV accuracy and ensures investors are not charged costs that should belong to the manager. While answering, focus on allowable versus non-allowable expenses, allocation methodology, expense caps, related party charges, documentation, approval authority, financial statement classification, and investor transparency. Question 14. How would you evaluate whether a valuation methodology change is appropriate? A methodology change should be driven by better information, not a desired valuation result. I'd ask what changed: market conditions, investment life cycle, available data, capital structure, or company performance. Then I'd compare the old and new methods, quantify the impact, and confirm the new method reflects market participant assumptions. Material changes should be approved by the valuation committee and disclosed if required. Consistency is important, but accuracy and relevance come first. Make sure to cover rationale for change, consistency requirements, market participant assumptions, comparability, approval by valuation committee, impact analysis, disclosure implications, and avoiding outcome-driven methodology shifts. Question 15. How do you prepare for an audit focused on valuation and regulatory compliance? I prepare by making the audit trail complete before auditors ask. That means valuation memos, pricing support, Level 3 model files, committee approvals, reconciliations, expense support, compliance checklists, and evidence of review controls. I also pre-identify judgmental areas such as stale prices, side letters, related party expenses, or methodology changes. Clear documentation reduces back and forth and shows auditors the process is controlled, not reconstructed after the fact. In your answer, talk about audit-ready documentation, valuation memos, price testing support, reconciliations, policy evidence, compliance checklists, management representation, issue tracking, and timely auditor communication. Question 16. How do AML, KYC, and investor eligibility requirements affect fund accounting operations? AML and KYC affect accounting because investor activity should not be processed without proper clearance. Subscriptions, transfers, and redemptions depend on verified identity, beneficial ownership, sanction screening, tax documentation, and eligibility under the fund documents. From an accounting perspective, I would coordinate with transfer agency and compliance before admitting capital or processing payments. Strong controls prevent unauthorized investors, regulatory breaches, and incorrect capital account or share register records. Be sure to mention subscription acceptance, investor onboarding, restricted investors, beneficial ownership, sanctions screening, transfer processing, redemption controls, record keeping, and coordination with compliance or transfer agency teams. Question 17. What are common regulatory reporting obligations for funds, and what accounting data supports them? Regulatory reporting varies by jurisdiction, but fund accounting often supplies the core data. Reports may require NAV, gross and net asset values, investor concentration, leverage, liquidity buckets, counterparty exposures, asset classifications, and performance information. The challenge is data consistency across accounting records, portfolio systems, and administrator reports. I would reconcile key fields, document source systems, and review anomalies before submission, because inaccurate regulatory data can create serious compliance risk. While answering, focus on jurisdiction-specific filings, portfolio holdings, leverage, liquidity, investor concentration, counterparty exposure, NAV data, financial statements, transaction records, and data quality controls. Question 18. How would you handle a breach of an investment restriction discovered after month-end? First, I would confirm the breach against the fund documents and determine when it occurred. Then I'd quantify exposure, NAV impact, investor impact, and whether any fees or trades were affected. I would escalate immediately to compliance, the investment manager, and senior finance. Remediation could involve trade correction, reallocation, disclosure, or investor notification depending on severity. Afterward, I'd address the root cause with stronger pre-trade or post-trade controls. Make sure to cover breach identification, root cause, materiality, NAV, and investor impact, escalation to compliance and management, remediation, investor notification considerations, and preventive control enhancements. Question 19. How do you assess whether a broker quote is reliable for valuation purposes? Not all broker quotes carry the same weight. I'd consider whether the quote is executable or indicative, how recent it is, whether the broker is independent, and whether multiple sources support it. I'd also look at bid-ask spreads, trade activity, market movements, and consistency with prior valuations. For thinly traded securities, I'd document why the quote is reasonable or whether a model overlay is needed. Reliability depends on evidence and challenge. In your answer, talk about executable versus indicative quotes, number of sources, independence, quote age, market activity, bid-ask spread, consistency with other data, and documentation of challenge procedures. Question 20. As a senior fund accountant, how do you balance NAV deadline pressure with valuation and compliance quality? Deadlines matter, but a fast NAV that is wrong creates bigger problems. I manage pressure through a disciplined close calendar, early price checks, predefined materiality thresholds, and clear ownership of reconciliations and reviews. High-risk areas like Level 3 assets, fees, side letters, and manual entries get priority. If something is unsupported, I escalate rather than force the close. Senior accountants add value by protecting quality while keeping the process moving. Be sure to mention prioritization, close calendar discipline, risk-based review, escalation, materiality thresholds, checklist controls, communication with stakeholders, and refusing unsupported shortcuts under deadline pressure. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.